Welcome to Alpha Wolf Capital. I'm Tim, and I want to personally thank you for stopping by. This channel is designed to help small companies, both public and private, gain exposure with potential consumers, investors, even partners. Take, for example, today's guest, CEO Jack Ross of Synergy CHC. Synergy CHC wants to make people's lives brighter and better through their consumer healthcare company. Synergy brand is something that will help consumers find a brighter, better life they desire in proven and tangible ways. They intend to leave a footprint of health and wellness in North America and beyond. Synergy has two brands. One is FOCUSfactor, which is nutrition for the brain, and the other is Flat Tummy, which is a weight loss product for women. Both of these products are Impact products, but I'm going to let Jack tell you more about that in just a minute. This is not to be taken as investment advice. I am not a certified financial planner. This is for education and entertainment purposes only. I encourage everyone to do their own due diligence. Hey everybody, Tim from Alpha Wolf Capital coming at you with a brand new company, brand new CEO for me, Jack Ross from Synergy CHC, which is where did the Synergy CHC come from, Jack?
Yeah, so Synergy CHC means consumer healthcare, actually. So we built a portfolio around the products around consumer healthcare.
Got it. But the one is the product that you have that has my attention that I'm actually, this is my third case that I'm working
Love it.
is FOCUSfactor, and it's an energy drink, but more importantly, it's also to help you focus. It's brain nutrients in there, right? And I actually love the taste. So I'm an energy drink junkie, and I really like the taste of your product, and I do think that it helps me focus. Now, it's not, you didn't start out with just the energy drinks. You actually started out with nutraceuticals with the vitamins, right?
Correct. Yeah, so a little bit about we'll call FOCUSfactor. FOCUSfactor's got 25 years of we'll call brand heritage. It actually started the brain health category, meaning we were the first one to market. What separates FOCUSfactor from we'll call the rest of the brands in the category is it truly has a clinical study on all 52 ingredients. Now we're talking about the pills here, Tim. So this is the pill business. 14 years it's been in Costco, 18 years been in Walmart, 25 years of brand heritage, a clinical study done by cognitive research on the entire formula. And why that's important is it's unheard of in the supplement space. Usually you usually get one ingredient or two ingredients, i.e. our competitors, and they sort of clinically study the one or two ingredients, and then they sort of put them with another 20 ingredients, but they really don't know how they interact with those 20 ingredients. Where FOCUSfactor is unique, where all 52 ingredients have been clinically studied together, and the claims that come right out of the clinical is improves memory, concentration, and focus. And why we like the brain health space is, obviously started the category 25 years ago, but if you sort of look at the projected CAGR of the category, brain health continues to grow double digit each year, if you will. You sort of look at the aging population, the pills itself are set up for a plus 50 crowd, plus 45 crowd. So you look at that demographic in the population, you can clearly see that, for years to come, that's going to be an incredible category with double digit growth. And when you sort of mentioned the RTD. Started getting excited about the RTD about a year and a half ago, and we sort of looked at Celsius as the model. And at that time, Celsius was weight loss and energy, fat burn and energy. So it was a dual benefit drink. And, it sort of caught our eye, and we sort of said, watch the explosive growth there and the valuations that they created and the returns they created for investors. And we said, well, why not us? We're, the leader in the brain health category. So why not focus in energy?
Right.
So we went ahead and we said, you know what? We're going to test this thing. We created a drink with 3 flavors. You sort of mentioned it. It tastes really good. We haven't had not one single retailer tell us it hasn't tasted good. So when we brought this to market, we, obviously had the trends on our side. We said, the brain health growing double digits, ready to drink category in functional side growing double digits. So we sort of said, oh, we're hitting a grand slam here. So what do? We said, you know what? We're a 14-year relationship in Costco. So with our pill business, we're in all their stores in the US. We're in all their stores in Canada. We're in all their stores in the UK. And right now we're going into Mexico and Taiwan here before the end of the year. So when we sort of looked for a dance partner for our ready to drinks, we reached out to Costco and we said, hey, even though we don't have a drink today, we can't let you taste it today. We we would like to see if you'd like to test it if we developed one. And they said, listen, Jack, of course, you're 14-year partner. We really look at Costco as a partner, not a retailer. You've been on the outside back cover of Costco's Connection magazine ad. So that goes to 60 million homes once a month, and it goes out 12 times a year. And FOCUSfactor's pills have been on that outside back cover 6 times a year for the last 14 years. So clearly, they said, our 60 million members know your brand. We understand what's happening in brain health. We understand what's happening in functional beverage. So of course we'd be interested in trying it. So we went away and we developed it. We brought it back to them so they could drink it and taste it and feel it. So we went into in July or August of 23, we went into Costco, Texas region for our first trial of our ready to drinks. And we went in for a 5-month trial. And to be successful in Costco, in the beverage section, you need to do between $2,000 and $2,500 per week per building. And by the end of the 5-month trial, of course, we did the demos. We let people taste them. We had the pallets there. We had an 18-pack, a variety. And by the end of the trial, we were basically hitting their numbers. We were about $2,300 per week per building. And our trial time was over. So we sat down, being partners we are, and they said, we'd like you to stay in, but would you be open to some feedback? So, we don't have the picture here today to share with the listeners, but we were very much, we'll call a darker looking package, more like a monster looking. We had set it up to be more millennial based, more younger, if you will. So Costco said to us, listen, would you guys be open to some feedback and some changes to your packaging? Because, one of the reasons we brought you into our locations here, is we know that our 60 million members know the brand, except now you've taken the drinks and you've making it a sub-brand that sort of doesn't even look like the brand of the pill brand. So we think you need to connect the dots to create a family look, which is sort of what we did up here in the right-hand corner on the screen, if people can see that. Now the entire family, whether it's a pill, a kid's pill, a coffee, a shot, or an RTD, it has the exact same family look. And that was worked on in conjunction with Costco to develop that. So they said, listen, if you'd be willing to do that, we'd be willing to leave it in, and as you work towards that. And we said, listen, Thank you for the feedback. We think you're absolutely right, but we don't want to keep building older packaging and building a brand and getting consumers used to a brand that we intend to replace. So we went away, we went out of Texas, and we redid this brand to what you see there. So then we went and we said, okay, let's test it in another we'll call territory. So we did all 102 stores of Costco, coast to coast in Canada. We did a 3-month trial, not a 5-month trial, with the new packaging. And we essentially hit their numbers after 3 months, meaning $2,200 per week per building. So, and in Canada, we've only been in all their stores in Canada for like 5 years. And in Costco US, we've been in them for 14 years. So we really thought we sort of had something. So, and just to dimensionalize that for your listeners, Tim, and this isn't guidance in any way, but it's just as dimensionalizes the opportunity at Costco. If you I mentioned to you $2,000 to $2,500 per week per building. If you said today, with our pill business, we're in 706 of the 872 stores of Costco's global locations. With our pill business, if we took that same thing and applied it to 706 stores with our drink business at $750 per week per building, which wouldn't be enough to sustain the business, it's a $34 million opportunity just at Costco, one retailer. And at $1,500 a week, it's 68 million. And at $2,500, which we were closer to, it's a $130 million opportunity at Costco. So you can see why we're so excited about that.
Right.
So I hope that helps dimensionalize why the move from pills to RTDs as well.
All right, let's talk about FOCUSfactor is the main entity that I'm interested in, but you also have Flat Tummy, right? Which is you want to share a little bit about Flat Tummy?
Yeah, sure. So going back to we'll call Synergy umbrella, Synergy CHC, really what we're building over there is a portfolio of consumer healthcare brands. So we acquired Flat Tummy out of Perth, Australia in 2015, and it was largely in the digestion, debloating business. It had one SKU. But what we liked about it when we acquired it from there is it really, brought us into we'll call the digital age, the social media age. So they were very strong at influencer marketing, celebrity marketing, very strong at digital marketing, and we hadn't had that component at our company at Synergy CHC. So when we looked at it and understood it, we instantly acquired it. And, we've grown Flat Tummy. If you sort of look at the social medias over there, 1.6 million followers on Instagram, over 500,000 on Facebook, 2 million girls in the database that actually bought the product. We've got 75,000 bloggers in our database that we've actually done paid collaborations with. Everybody from, we'll call the entire Kardashian family multiple times, to micro bloggers all the way down to 10,000 followers. So we know how to do that. We know how to do it at scale. And, as we sort of, look at the rest of the brands in the portfolio, we thought it was very important to have those skill sets to roll out on social media and to launch effective marketing plans as we scale the rest of the brands, if you will.
Okay. So in total, I just actually found this out before we hopped on. In total, you've got what, 8 brands?
Correct. We got 2 brands that are revenue generating. FOCUSfactor does 88% of our revenue today, and Flat Tummy does 12%. And that's really only been held back by, we'll call our balance sheet, if you will, which we'll talk about in a minute. But we've finished a major refinancing, to help our balance sheet. So our debt now is interest only for the rest of this year, and small, 5% principal next year. Where really, if you sort of reflect back to the last 2 years, we were paying out more than $10 million a year in principal out of cash flow. So it alleviates our cash flow to be able to use for growth again in a big way, our refinancing. So now we can take, and say, we don't need to grow one brand at a time. We can grow Flat Tummy. We maybe can grow another brand or two. So it really frees up our resources to do that, if you will.
Okay, but you've got your primary focus right now is FOCUSfactor.
Yeah, when you sort of look at the opportunity and you say, going back to, the CAGR growth that's projected, not only the pill business is projected to continue to grow, our geographical footprint, going into Mexico and Taiwan, and those are both with Costco, by the way. So in Mexico, we'll add other retailers as well. We'll
Well,
continue to.
that's one thing. The one thing that can be concerning from an investor standpoint is that yes, Costco is a big player. Costco is also, it sounds like, the majority of your business, and that's a scary proposition, right?
Yes, I would say that you're absolutely right. If it was a new relationship, Tim, meaning that, anytime even someone says to me, "Hey, I got a brand that's growing fast," we just went into Walgreens. Well, I look at that as a negative because it's a new relationship. But you got to sort of look at, the totality of the relationships here. 14 years we've been in Costco,
Right.
a trusted partner, growing every year. 18 years we've been in Walmart. So when we look at, a new geography, it's because we've already proven that it's not something that, it's a higher risk moving into a new market. Um, because we've already made it work in other markets, meaning Canada, meaning UK, meaning the US. So normally I would say yes, other than, obviously the long-term relationships matter.
Right. And it's not as though you are not opening new accounts with new retailers. And I mean, it's not, you're
Yeah,
not,
so so we continue to grow Costco and other things, but just in the first quarter of this year, we opened Publix supermarkets, we've opened BJ's. This year we're hoping to get wins at don't know, you never know until you get to ring the bell, but we're hoping to get wins at Kroger and Target this year. So, and we continue to add we'll call smaller retailers, but we continue to grow in new retailers. We continue, don't forget, even at Costco, they continue to open new stores. So there's, a couple ways to grow here is you continue to add new retailers all the time, or you take more SKUs and get them into the same retailers. So, i.e., Walmart, you get two SKUs sitting in the vitamin section, but all of a sudden, if you get your RTDs and your shots sitting in the beverage section, you continue to grow those relationships, and you already have the vendor number, and you're already a trusted partner.
what about convenience stores? Are you, what,
Yeah, if you look at largely a lot of the releases we've made here in the last, we'll call press releases in the last 60 days, they've been largely in the, we'll call, convenience store side of things. We've been fortunate enough to add some, we'll call, quality people, long-term people in the beverage side of things, primarily coming from the C-store side of things, and from the beverage side. So, we've been, ever since we'll call refinanced our debt, we flicked the switch to go mode, and we've been actively signing wholesalers, coast to coast in the U.S., redistributors, DSD partners, and retailers, and obviously the people that we've added on the other side have 25, 30-year experience in that, we'll call, sector. Yeah.
okay. All right. So let's talk, let's go back to maybe an uncomfortable time, and let's talk about the debt, right? Let's
Yeah.
talk about what happened there.
Yeah, well, it wasn't really an uncomfortable time. It was, let's just say that all the brands were acquired with that. We never raised any equity whatsoever to to capitalize the balance sheet because we were always profitable. Meaning, We always threw off good cash. We paid down our debt. Um, but then came 22. So every year since existence, since 15, we were profitable other than 22. And 22 was the year that was coming out of COVID, if you remember correctly.
Yeah.
And if you remember correctly, all the headlines sort of, Tim, that was out there was, you know, Target way overstocked, Walmart way overstocked, supply chain jam. Well, we sort of got ourselves in the same situation where we had to write off about $12 million alone just in inventory that year, which put a squeeze on cash. So, and then, there was a couple other things that, we had fired up for marketing because coming out of COVID, everything related to vitamins and health, we're sort of on the up curve. So we were doing more marketing and put more marketing. Make a long story short, we took a substantial hit in 22. So in the next few years, what we did is we concentrated on paying down the debt. I think we had about $52 million between current liabilities and long-term debt after 22. And today we've got, somewhere around 30, if you will. So just out of cash flow without raising any new equity at that time, we paid down about $22 million. So very healthy business, if you will. But it was uncomfortable. And we needed to ensure, that we got that structure right so that, we could give the business some breathing room. And the breathing room now that we have is this interest only, which is about $3 million a year of interest coverage. The business is making about $10 million, trailing 12 months of EBITDA. So now we've sort of freed it up where our balance sheet is generating about $6 million worth of free cash flow, if you will. So then we sort of looked at it and we said, okay, well, we got this wonderful opportunity for RTDs. How are we going to take advantage of it? So last October 24th, we did an IPO with Roth. We took down the $10 million of equity, which really was 6.2 million net cash to the business, which again, we took the opportunity to right size everything. We'll call pay down where we could and set ourselves up for growth with our RTD business. So that was really the first time in the company history where we put equity into the business.
Okay. And then that's when you kind of did the rebranding thing, and
Yeah.
that was also so Costco didn't want to load up with a bunch of they had to sell through with your old stuff, right?
Yeah. So the way rebranding works in our business, at least, is that it's called a flow through. So we literally don't take back the old packaging from any retailers, whether it's Walmart, whether it's CVS, whether it's Walgreens, whether it's Costco. It's a flow through. So what happens is we go to the retailers and we say, okay, we're going to launch this new look. Here it is. But they have their existing inventory of we'll call older packaging. And what they want to make sure is at that time is they slow up orders, if you will, to ensure the old product is out the door, out the door, out the door. And they take the opportunity to run it down to dangerously low levels of inventory before bringing in the new packaging because they know once they start setting that new packaging there, it's going to slow down the turns of the old packaging. So just in the four major retailers, that cost us about $7 million last year of sell-in as they reduced inventory levels before they right-sized their inventory levels, if you will.
Right.
But that's a normal process. And, although maybe we didn't think about it properly at the time, and it certainly wasn't fun at the time, and there's never a right time to do it. It was the right thing to do for the business. We hadn't refreshed our FOCUSfactor brand in 10 years since we acquired it, and it needed a refresh. And we heard Costco that said, hey, you got to bring them all together. with the RTDs and then this and then that. So, it's one of those we'll call unfortunate or fortunate. It's just a business decision and condition, but it wasn't something that we'll call long-term in nature. We understood it was a short-term pain for long-term gain.
Okay. How many shares outstanding fully diluted does the company have?
Today we got 9.6 million as of today.
Okay. 9.6 million. And you refinance the debt, so it was an overhang. Now,
Yeah.
what does that enable you? What is it going to enable you to do?
Well, it's sort of if you look at the balance sheet now, and certainly we file on the 14th of August. Our working capital's gone from a negative working capital because all our debt was current in nature. So, now we've got, I guess, about $11 million of working capital now, if you will, and generating approximately $6 million of free cash flow.
Okay. Okay. So I'm envisioning marketing that's going to get.
Yeah, so we're going to turn our TV on with that money, which if you sort of go back to the IPO, that's what we intended to do. Turn the TV back on. We know that when our TV was on during COVID or post-COVID, it was creating for every dollar we spent on TV, we were getting $2 to $3 on top line revenue. So very nice awareness. So, we advertise on the news networks mostly, Fox, CNN, CNBC. So it captures that 45 demographic plus very nicely. And it's almost instant. The day we turn it on, boom, we start seeing the sales numbers the next week. So now we get the cash on the balance sheet to be able to do that. And then most importantly, build the inventory for RTDs, which is currently being built as we speak. And we'll start delivering that inventory to retailers for RTDs in third week of August.
Okay. So everybody knows right now you've got the drinks and you've got the nutraceuticals. The shots, are they available now or?
They will be in September.
Okay, so the shots will be available in September, and I imagine your pricing is going to be in line with whatever.
Absolutely, almost identical.
Okay, and then you've got the 3 flavors now, but you've got 2 additional flavors coming for.
Yeah, we have 3 flavors in the RTDs that has been time tested. We'll call it. We've got 2 new ones sitting there. That's approved that will roll out next year, early next year. And then for the shot business, we have 2 flavors in our regular strength and 3 flavors in our extra strength. That'll all be rolled out at the same time, if you will.
Okay. And margins are.
Margins are a little less than the vitamins. I'm glad you brought up the margin question. We're fortunate enough in the vitamin business, we get 75 plus points of margin in the vitamin space. So we'll definitely want to continue to grow that business. Certainly in the beverage side of things, it's lesser. It's about 62 gross and about 50 net, if you will. So, but when we sort of look at, how we're going to market here, we're not adding, we'll call a ton of overhead. So it should contribute at almost the same level down to the EBITDA line.
Okay. And I mean, as I look at it, you're a 14-year partner with Costco, and you haven't really you've done the tests, you've done the pilots, but you really haven't done a full-blown rollout with the product where you combine the vitamins with the drinks, right?
That is correct. That is correct. So we just did the testing really 2 different categories, right? The vitamins in the pharmacy section and the drinks are over in the beverage section. But it doesn't stop us from doing what you said. We'll get those outside back covers. So, obviously we pay substantially for those to be on that 6 times a year, but it doesn't stop us from adding new and available drinks and basically adding the same couponing, cadence to both of them at the same time.
I mean, look, if you're gonna take the pills, you need something to drink to choke them down, right?
Absolutely. A- Absolutely. And what we love the best, Tim, too, is that, take the listeners back to, you know, um, both of the categories we're in, whether it's brain health by itself, improves memory, concentration, and focus, growing double digits for the next bunch of years, the industry's talking about. And then you sort of look at the functional beverage, you got pretty much every retailer now sort of looking at it. If you want to take a step back in time and say, 3 or 4 years ago, 5 years ago, the retailers, whether it be Walmart or Target or Walgreens, they'd be looking at their beverage sections and they'd saying, listen, all we really need is Monster, Red Bull, Rockstar times 20 flavors. Yeah. Now they're looking at it at their planograms and they're saying, wait a minute, what we need is those, yes, but we probably need 6 flavors of each of those. But what's really the explosion, if you've watched, some of these brands come along like Poppy, it's about functionality. And, whether it's sleep, whether it's gut health, whether it's brain health. So these planograms will start exploding into functional beverages as well.
And does that data apply to the data that backs your clinical on the nutraceuticals? Does that apply also to the drinks or no?
No, it's a different formula on the drink, and the pills. The pills claim to fame is improves memory, concentration, and focus. That's
Okay,
the clinical study. That's what it proves. On the drink side, what we're going for is it improves focus and energy. It
okay,
doesn't improve your memory. It includes your focus.
got it. And
Okay.
that is that something that you're actually going through testing, clinical testing on?
The ingredients in there are clinically tested for the claims that we make.
Okay, got it, got it. Okay. Um, what are you most excited about now?
I'm just excited to finally, we went public a year ago. These are all stepping stones that we need to achieve, to actually do the fun part, the execution of what we've tested. So now we're finally sitting here. We've got a nice clean balance sheet. Um, you know, um, we're adding retailers, we're adding wholesalers. Growth is fun. Profitable growth is fun. And that's what I look forward to the next bunch of years.
Okay, so the I guess the thing that always concerns investors is lack of cash, right? And
Yeah.
need for cash. I mean, if is there a need to raise capital?
So I just mentioned to you, free cash flow, why? Our payables are cleaned up, put it this way. Our long-term debt's in check. We generate $6 million worth of free cash flow, if you sort of do the math there. Um, So, you know, it really depends on how fast we want to accelerate the business, if you will. So the cash will be used largely to build inventory.
Okay,
So you know, if we sort of, we're out there obviously marketing and signing retailers now and wholesalers and DSD partners, and we're having some really, really strong success at it. If in fact, we sign them quicker than we want to, we may do a small raise.
right. And you know what? To me, if it's one thing to do a raise to pay your bills, it's another thing to do a raise to build inventory because you got a bunch of sales, right?
Correct.
I mean, that's a different, you know, raising capital is not always the worst thing that can happen for a company. Sometimes raising capital means they've got tremendous growth. Growth consumes cash. Bottom line,
Yeah,
right?
yeah, and creates value.
Right, right. So I mean, if you're going to build out this brand, then I think I think you do what you need to do to make the brand successful, right?
A- Absolutely. Absolutely.
Right.
But we don't need to destroy the cap table to do that.
Right. Exactly.
Yeah.
And I think you understand that, right?
Yeah, and maybe that's a good point to talk about is that I'm very much aligned with the shareholders here. On the last IPO, I wrote a check for $2.7 million at $9 a share. I own more than 50% of the outstanding stock. So, so, so I'm very aligned with the shareholders.
So yeah, it would be fair to say you are yeah, very aligned with the shareholders, right? You own
Right,
50% of the stock.
right.
You've got skin in the game.
Got skin in the game, and if I'm going to raise or do something, it's going to be to grow the value.
Right. Right. It's not to dilute the shareholders and hurt everybody. You have a small enough share count that that is still could be concerning to people what you're demonstrating, and I think you don't even really know. You don't have a real clear picture of because I think with the new branding and actually really getting out there and hitting it, this thing could go quick. I mean, this thing could grow very quickly. And I didn't buy these. I didn't have these things shipped to me because,
Thanks for the sale, by the way.
uh,
Thanks for the sale, by the way.
yeah, you're welcome. I like the. I mean, I like it. I like the product, right? So that's kind of big for me to go out of my way to have it, order it, and have it shipped because I don't have it at my no. I usually buy all my drinks from the local convenience store, right? I mean,
Right.
this is like super simple. I have it shipped from. I think I had it shipped from Amazon. Actually,
Yep.
you're on Amazon, right?
Correct.
Yeah. So I think I got it from through the Whole Foods thing, but I mean, I love the drink, right? And I'm looking forward to the additional flavors. And these things, this is a very it's a hot business that doesn't seem to ever die down, right? I mean, it started out with Red Bull, and then it was, Monster, and it just keeps. It seems like there's a new brand
Yeah.
popping up every day, right?
Well, and then you sort of look at the fresher stories, right? You sort of look at what's happened to Celsius. Incredible growth. They finally got at that inflection point, and Pepsi invested 850 million into them, and then whammo, they were north of $1 billion in sales. And then, just the last couple of 3 years, you got Alani Nu that, Celsius bought. That was a new entrant, and they're more than $1 billion a year in sales now. You got Poppy. So there's lots of examples of we'll call new young brands growing very fast, to that $1 billion level. So when you look at a brand like FOCUSfactor, you know, I'm not sure I would have the stomach for trying to launch a beverage brand if nobody knew the brand name and we
Right.
didn't have the long-term relationships. But don't forget, we had long-term distribution relationships with Costco, Walmart, BJ's, Walgreens, CVS, to name a few. Sorry, throat's bad. And then you sort of look at, the trends on both sides of the brain health thing. I think we're hitting it at the perfect time.
Is there at some point would there be any plan to do some more clinical studies on or adjust the I guess the ingredients that really try and enhance the brain health thing or no?
So when you look at the clinical study we have, we're very fortunate that it's the best in the business. It's gold standard clinical, done by a pharma grade clinical house. So we're reluctant to sort of open up that study because it is so good, if you
Right.
will. And for years and years and years, whether it's Prevagen or Nariva or any of those guys, they haven't been able to duplicate the successes of our clinical study to the point where, if you look at Prevagen, which is, the largest in our category, last December, they sort of got news from the FTC and the Attorney General in New York that they couldn't make improved memory concentration and focus claims anymore because their science didn't work. So they had to take off of their packaging, and then if you look at it today, it doesn't say improves memory, concentration, and focus anymore,
Okay.
if you will. So the clinical study that we have is so good, so we'll call gold standard for the supplement space. We really don't want to touch it at this point in time.
Makes sense. That makes
Yep.
sense. All right. I think, and actually, I've got your chart up on the screen. We just can talk about it. So you recently had a nice little move, right? Well, and that I think was after you got the deal with the debt done, right? That's
Yeah, I
correct.
think there's a bunch of bunch of things there that's happening. Don't forget, we went public at $9 a share.
Yeah,
So, then we went into, like you had mentioned, the rebranding and we'll call the inventory slowdown. So, that cost us on the cap.
yeah.
And then, we had to get to work on our debt, which was the largest catalyst here. Once we got that done, we started to move pretty nicely back.
Okay.
And then the minute that we did get our debt redone, it gave us the confidence to be able to go and say, okay, now we're really going after the beverage side. And we made a couple really good hires that we announced with long-term experience in the beverage side. And then we started securing major distribution and we'll call in the beverage side to ensure that when we sign up a retailer, that we have distribution for them in the territory, whether it's a redistributor, a wholesaler, or a DSD partner that can actually service them. So we've been active there, and we've made some news releases around that. And I think that the market's generally seeing, that we're going for the beverage side now.
So, what do you feel as though could be the next catalyst? When should we have you back?
Yeah, so third and fourth quarter is execution time. We've made some press releases around there. We're going to start seeing some we'll call beverage revenue added to our P&L. So I would say sometime early in the first quarter, if you will, and we can talk about those wins. We'll continue to do press releases around the retailers that we're bringing on board, which will be very substantial. And but we'll be able to talk more to the numbers. But sort of took you through the numbers, the opportunity just at Costco. So we're going to focus on bringing those regions back, at least one in the fourth quarter, if you will. So you're going to see substantial moves here.
So, is your fiscal is yours
December.
okay? It's December. Okay.
Yeah.
Okay. So when are you reporting? You're reporting in August?
Yeah,
Maybe
August 14th.
maybe we come back and do an update after you report because you'll have a little bit more to talk about there.
Sure. Happy to do that.
And then the same thing after the
November.
yeah, absolutely.
Yeah.
I mean that
Happy
way we just keep you in front of people's eyeballs, you know what I mean?
happy to do that.
Okay.
Sure.
All right, Jack. Anything else you feel like I missed anything?
No, I think you covered it. You know, generally we could stay on here all day. I love talking about the brand. I love talking about the growth opportunities and certain our ability to make money. But at some point you got to condense it. And I just thank you for your time today.
No, you know what? I mean, here's the thing. This is I'm an investor. I'm not a short term looking for I'm looking for companies that make an impact, have an impact on humanity, right, in a positive way. I think the energy drink space is an interesting space. I think focus is especially as I get older, right? It is an
We all
important
do.
thing for me. Uh, so my father had passed from dementia, so that is something that is on my mind, right? So I do try to take care of my brain, the brain health, and this product. I like the product, and I think it's an interesting space to keep an eye on, right? I think
Yeah.
you have an established brand. I think this could wind up taking off for you, right? And it could be an opportunity for your portfolio to do well. Also, the debt is out there. but you can't, you have no problem coming on talking about it, right? I think
Nope.
transparency is key. So it's not, to me, it's not just the product, it's also who's leading the charge. That's important to me, right? I can look you in the eye, and you and I are now building that relationship of, can I trust him? Does he execute? Right? That's
Right.
where we're at right now. So,
Yep.
I mean, so far, everything that you told me you were going to do, because I actually talked to you a couple of months ago, and
Correct.
right, and you said, "Hey Tim, this probably may not be the best time. I'm in the middle of working this. Let me get this debt stuff handled, and then we'll come back." Right?
Right.
That's
Right.
exactly where we are right now today.
Yep. Did we do what we say we were going to do from 2 months ago?
Yes,
Okay.
that's why we're here, right?
Perfect. Perfect. Perfect.
That's why we're here. So
Exactly.
now we're gonna keep on this path. You've got a very low share count, right? That's
Yep.
nothing. I mean, it's nothing. The debt may seem like a lot, but when you start throwing off cash, and I mean, you did pay down a big chunk of debt from cash
Sure,
flow, right?
sure did. Sure
And that
did.
was before the drink. So I mean, if this thing really takes off for you guys, that could go away quickly,
Very
right?
quickly. Yep.
So that's what I'm trying to convey to people, and that's why I want to get people watching the story right now, right? Because
Perfect.
this is the time. And if your third and fourth quarter are usually your best quarters, right? That's also a good thing. So
Exactly true.
yeah, so
Yeah.
I'm looking at the stock right now. You're coming up to an area of resistance, and I say that because it acted as support. But in this 350 area, there's a little bit of resistance, but you're holding above it. And you've got what is that you've got coming up right now? I think that's the SMA. That's a 20 SMA. It's about to cross over the 50. And I should have looked to see if you had the golden cross. But I mean, all of the moving averages are starting to slope up, and it actually looks as though you've broken the long term trend, which was down. It was from the upper left to the lower right, and it looks now like you've broken that trend, right? And anytime you've broken the longer trend, which is the dominant trend, that's a very positive thing. So
Yep.
literally, this could be the beginning formation of a long term trend that goes from the lower left to the upper right, right? And that's where you want to be. So we'll see what happens, Jack. I mean, I'm pulling for you,
Okay. Thank you for that.
and we'll have you back. We'll have you. It'll be a quick one. This was a long one. This was the introduction.
Oh, no, that's fine. Like I said, I could talk all day here. You probably had to cut me off a few times.
How did you just because I don't think I touched on this, but how did you get involved in this? How did this
So
occur?
I've only done a couple things in my life, but I spent 25 plus years in the video distribution business. So
Okay.
store within a store concept. So what we did there for successfully for 25 years. Remember when we all used to rent movies down at Blockbuster, right?
Yeah.
The we did convenience stores, drug stores, and grocery stores where we actually physically racked them with the racks, the product, the computers. That was all our physical inventory. And then we put it into one of the retailers, and then we shared the revenue with the retailer. They put up the human capital and the physical space, and then we put up everything else, and then shared the revenue. So again, we did that successfully for 25 years. Long story short, technology changed that for everybody. And
Yeah.
we were really looking for something else to do and said, hey, we got these long-term relationships in convenience stores, drug stores, um, grocery stores. I was really looking for to do something next. And I happened to be um, at an LA Kings hockey game in a box with a bunch of friends. And a gentleman came up to me and said, hey, what do you do? And I said, well, I'm sort of between gigs right now, but I'm looking for something. He said, what did you do? And so I told him, and he says, hey, have you ever heard of vitamins and supplements? He says, I got a brand that I know that's for sale, and it was FOCUSfactor. And literally from that box in that rink, I literally called that guy and set up a time to speak to him, and literally bought the brand from Paul Levinson in New York in about 3 months. If you will.
How long ago was that?
That was January of 15.
January 15th, and that you were just off to the races with it.
Off to the race. Didn't know anything about supplements, but what a beautiful business. It fit in perfectly to our long-term relationships, drugstores, community or drugstores, grocery stores, and that type of environment. And nice repeat business. So it was like the video business, the repeat business at videos was every Tuesday, and the releases come out and everybody would come and rent more. Where this thing, once the bottle's out, they're buying another bottle because it works.
Yeah.
Right. So repeat business is key, and the margins, beautiful margins. So yeah, that's how FOCUSfactor happened.
All right. Awesome. All right. Thanks, Jack. Thanks for doing this. Hold on one second. I'm going to shut this off.
Okay, thanks, Tim.
Thank you for tuning in to another CEO interview here at Alpha Wolf Capital. Today we had Synergy CHC CEO Jack Ross. I hope you enjoyed today's interview, and if you did, do us a favor, give us a like. How about giving us a share? And while you're at it, make sure you smash that subscribe button. All of those things are extremely important to us here at Alpha Wolf Capital, and we appreciate you taking the time to do that. Until next time, stay safe. Alpha Wolf Capital wishes you the very best of success.